Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's get more on the jobs data here. Joanie Bily is Chief Workforce Analyst over at Employbridge. Employbridge is the largest industrial staffing firm in the United States. It's great to see you, Joanie. We love having you every jobs day to get the perspective. What was your take on the numbers?
Well, certainly a lot stronger than I expected to see, as many of us were surprised by the big number. But, overall, I think just as your last guest, Vince, was saying, there is a little bit of a disconnect between the establishment survey and the household survey. So overall, looking at the job growth, again, we've talked about this in the past. We're seeing some strong growth, certainly coming from the healthcare sector, the government sector, leisure and hospitality. But in this report, we really did see that the establishment survey had many sectors across the board adding jobs. And I was very happy to see that the professional and business service sector kind of bounced back because that had been very weak. So we're seeing more of those white collar professional jobs come back, specifically in the technical and scientific area.
Hey, Joanie, I'd love to get your thoughts on just kind of the impact that immigration, both legal and more importantly, illegal immigration, because that's where the numbers are, how the immigrants are impacting the labor market.
Well, certainly we're seeing immigration overall. If you look at even, the past 10 to 15 years, we're seeing an increasing percentage of our overall labor force, from foreign-born workers. And that is projected to certainly continue. And it's actually helping the overall job market. So that, of course, is specific to the documented workers. If we look at illegal immigration, the government is certainly trying to work with the different states to get people documented so they can get to work. What we are seeing, I know in particular in New York, there's a tremendous amount of processing for these workers to get them documented and then to get them to work. But most of them will be looking for those lower level jobs that don't really require as much, skills and experience. And unfortunately, there's not a ton of those jobs out there. So that could have a big impact on unemployment in the future.
Mm-hmm. So I guess if we were to read between all of the lines, and if you're an economist looking at the data, what is your read? Like, are we as strong as the numbers say? Some survey data say something different. What do you believe? Like, what's your read on the ground?
So, I don't know if many people would like my answer, but I actually think that this headline number is a bit misleading. I don't believe the job market is as strong as the establishment survey is saying. I actually think the numbers in the household survey are a bit more accurate. We are seeing unemployment tick up for the first time. We saw a 4 in front of the number. Yep. We also saw that, not only are we seeing unemployment go up, but people are leaving the labor force and opting out of the labor force. We saw some big numbers there. And I'm just not, on the front lines, I have to tell you, in, Employbridge, as you mentioned, we focus on supply chain. We are certainly seeing more people looking for work. And unfortunately, there are less jobs to place them in. So I'm not saying it's a terrible job market. I mean, there are still jobs out there, but it certainly is a challenging and tough job market.
How about for recent college graduates? I mean, it's that time of year when
you asking for a friend?
No, yes, exactly, asking for a friend. So how about what's that environment look like?
Yeah, I worry about recent college graduates. There's less opportunities. for them. We're seeing that if you look at the overall JOLTS, job data, we're seeing a decline. We're down to 8 million, job openings out there. So less opportunities for them this year, even than last year. I will say, though, if they're going into healthcare, there's a tremendous amount of job opportunities in the healthcare sector, all different fields, all different types of positions.
That's interesting.
That is one of the strongest areas. So scientific, healthcare continues to remain strong. But, we're seeing a lot less in the financial sector, consulting, even software has declined. That used to be such a hot skill. It still is a hot skill, but less jobs available today than last year or the year prior.
So based on that, what are the wages like then in the healthcare sector? Is that need for talent or just humans reflected in wages also? Or are we still looking at like $8 people to get paid to take care of you in your home, which is not a nice proposition for anybody?
Wages have gone up significantly and almost doubled from the numbers, right, that you've quoted. So yeah, we've seen, certainly since the pandemic, we've seen a lot of movement in wages across the board, all sectors, logistics, manufacturing, but particular in healthcare. They were some of the strongest wage gains in 21 and 22 and 23. But I would say right now we're seeing a little bit more of stabilization. I'm not expecting big wage gains moving forward. I think you'll see it just kind of stabilize. But the wages have improved a lot over the last few years.
Joanie, what are your clients, your corporate clients saying about kind of their policies for work from home, hybrid, all that kind of stuff? Where have we kind of settled out on that whole thing?
Yeah, that is such a hot topic. It's a great question. Certainly, there are many jobs that it's not an option, right? Like the logistics, manufacturing.
Oh, we know, Joanie.
Yeah. Right, you do know. For you have to be there.
Every day.
So there's many jobs that really require you to be in the office or be on site. But employers that have kind of taken the strategy of offering more flexibility where they can, because they know that workers want that. Workers want flexibility in their schedules. They don't mind going into the office, but maybe having like a hybrid schedule is like the best, where they still get to collaborate with their, coworkers, and then still have some flexibility maybe to work from home for a few days. So that's where I see kind of the trend is these hybrid schedules. But, for many people, that's not an option, and you kind of have to come back to the office.
All right, Joanie, we really appreciate you. It's such great insight. Joanie Bily, Chief Workforce Analyst at Employbridge. Again, they hire a lot of industrial employees. So they really have the pulse on what's happening within the U.S. Thank you so much for joining us.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm Alix alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in finance and business through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies and 130 industries around the world. We also take you outside Bloomberg Intelligence to get the read on the market and investment. And what do you do when you have a day like today? David Dietze is Senior Investment Strategist at Peapack Private, and he joins us now. So clearly we're looking at a market reaction from the jobs that now we're looking at flat equities despite the bond sell-off. What do you think about this market right now?
Sure. So absolutely. We saw basically a divergent jobs report. And I think as we're looking at the market right now, it's really better for the U.S. worker, better for stocks than it is for fixed income. On the positive side, of course, more jobs were created than expected. And ultimately, as we know, 70% of that economy is the consumer. Not only are more jobs being created, but we saw a nice tick up in terms of wage growth in the last month, and indeed positive signs in terms of real wage growth. And so that's all good for spending. That's good for corporate profits. Therefore, that's better than you would think for stocks. And I think that's why stocks are shaking off some initial weakness there. Having said that, from fixed income point of view, it's not a positive because, of course, it continues the narrative that inflation is sticky. Remember, wages are such an important part of the overall inflation picture. This 4.1% year over year. Our target is 2%. So that's unacceptable if you're a fixed income trader. That's not acceptable for the Fed. And so that's why we're seeing bonds sell off, stocks get back on their feet.
David, if there's some that are suggesting that this jobs report maybe even pushes out a rate cut till next year. If that's in fact the case, can stocks work in that environment?
Well, so, at the end of the day, as long as interest rates or the Fed doesn't hike, I think we're all right with stocks. I mean, at the end of the day, you're buying stocks for earnings. And we just saw great earnings report in Q1. At the end of the quarter, the reports came in almost double than what had been expected. And we see that trend continuing for the rest of the year. So right now, Fed Fund futures, quite frankly, say is a coin toss for what we see in September. The real debate is now, are we going to get 1 or are we going to get 2 rate cuts? From an investor's point of view, we urge our clients not to overreact to just one metric. I mean, jobs are great, but, we're talking about what happened last month in stocks, and stock investors should be focused on what's the outlook for the next 6 to 12 months. And of course, when it comes time to the Fed making a decision in September, we're going to have several more months of data under our belt. From a stock investor, the worst situation is a recession. And of course, there was really no evidence in the jobs report today to suggest that the overall economy was weakening.
So what's your top sector pick then, based on all that, for the 6 to 12 month horizon?
We like everything other than those top 3 stocks, which we're urging our clients to lighten up on, which would be NVIDIA, Microsoft, and Apple.
And is that just a valuation call, though?
Absolutely.
Okay.
So small caps, of course, if you strip out 2 small caps in the Russell 2000 that are very much pushed forward because the AI hype, Russell 2000 is down for the year. Historically, if you look long term, small stocks have outperformed large caps. There's more room to grow. We think they're very much out of favor. We would just go with like an ETF that takes an index approach to the Russell 2000. We think that might be the way to go. The only reason where all bets would off if you see a very hard landing in the economy. But the fact of the matter is we have still a Fed put underneath us. So if we still see weakening, if we do see further weakening in the economy, that Fed will rush to the rescue. So we think that the small caps might be an area to take some of your winnings from those Mag 7, put them into the smaller fry.
Hey, David, a lot of folks are suggesting if you want to get some value, that perhaps international is a way to go, less tech weighting in some of the European indexes, for example. How do you think about international?
We think that makes a whole lot of sense. The dividend yields, for example, over in the continent are almost double what they are here. Valuations are much lower, yet their interest rates are even lower than they are here. And so the difference between what you get in fixed income and what you can get in terms of earnings yields and dividends on stocks, much greater. We think that's a nice opportunity. Of course, Japan has come back to where it was in the 1980s. And of course, the real sleeper could be China, which is, at close to a 4 to 5 year low here. But we just saw a big tick up in exports coming from China. Remember, China's doing almost the exact opposite of what our Fed's doing. Here we have restrictive policies, at least on the monetary side. While in China, they're trying to press the accelerator down to lift the economy out of their kind of pandemic and post-pandemic melees. And so I think that could be a real tailwind there. They could have some of the best technology in the world, but their tech companies are trading at about half the valuation of what U.S. tech companies are trading at.
What's interesting, too, you like real estate, and Moody's said at least 6 U.S. regional banks have a substantial exposure to commercial real estate loans, and they're at risk of having their debt ratings downgraded. What do you like in real estate? What do you not like? And how do you kind of avoid this kind of headline?
Yeah, absolutely. So in terms of real estate, what we're looking at is what has now already reflected the concerns there. So let me give you an example by virtue of one stock we like, Boston Properties. There, they have the commercial real estate exposure, but they're limited themselves to the six cities in America where people still want to go there. Your New York's, Boston's, Washington's, the high-end and then they have the high-end properties there. The stock is down by 2/3 of where it was. So obviously it's reflected a lot of damage there, but because their free cash flow has stayed strong, they have never cut that dividend. Now you got a 6.2% dividend. So, at the end of the day, I don't think everyone loves commercial real estate. No one will ever go back to the office. It's going to be somewhere in between. So we're looking at those high quality landlords that are publicly traded where the prices have now reflected some bad news. And sometimes you do well by buying when things aren't rosy, and then waiting for the situation to turn around.
David, how about financials? People are still, I think, a little leery about some of the banks in particular.
Yeah, certainly that's what we heard from Moody's. I'm not sure it's new news that some of their debt is on credit watch for weakness in terms of commercial properties. A lot of that, of course, has been reflected in the stock prices. At the end of the day, I do think that there is a strong policy coming from Washington to make sure that this banking system stays strong. Remember, that's the lifeline for a lot of smaller businesses in Main Street, USA, that can't tap publicly traded markets directly. And so I think if we want to, grow this economy and keep Main Street employed, we're going to have to make sure that those smaller banks get the lifelines they need. So that's going to be one reason why, of course, the Fed is going to be probably more dovish than the inflation statistics might otherwise warrant.
And just to wrap up, you also like 3M. I'm kind of obsessed with 3M. They're still a big conglomerate. They're changing CEOs, and they've really just stuck in and said, we're not spinning stuff off. Yes, they make the back of Post-its, that sticky stuff, but that sticky stuff goes everywhere in the world. Why do you like 3M?
Yeah, so this echoes General Electric, where you have an industrial conglomerate which is way out of favor. They have many different divisions. They were perhaps undermanaged, and of course, they had all sorts of litigation woes. Now they've got a new man in there, Mr. Brown. They've already spun off one of their divisions, Solventum. The stock is trading at a big discount to the market and way off where it was. We think that if the U.S. dollar softens a little bit because they're such a big international trader, that will benefit them. Of course, people talk about innovation. 6 cents of every dollar that they generate goes back into research and development. They're coming up with all sorts of patents. So we think that here is a situation just like what happened in GE. New management rationalize things, perhaps do some corporate restructuring, and you could see a stock price that could outpace the S&P 500 going forward. And of course, the dividend is still much higher than the S&P 500. All
right, David, thank you so much for joining us. Always appreciate getting a few minutes of your time. David Dietze, Managing Principal at Peapack Private.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Folks, how much we love these big take stories coming out of Bloomberg News. These are super in-depth reported source stories at really some key issues out there. Today is no different. The headline: Wall Street's CRE, the commercial real estate CLO machine, is wiping out apartment investors. I thought that was the safe part of the real estate market. I thought we were all just worried about office, but apartments also seeing some damage as well. One of the reporters on that story joins us here in our Bloomberg Interactive Broker Studios. His name is Scott Carpenter, Bond Market Reporter for Bloomberg News. Scott, talk to us about what's going on in the apartment real estate market.
Hi, good to be here. Thanks very much. So here's what's happening. You have retail investors, ordinary people with a little. They're pretty wealthy people. Say you've got around $1 million of net worth. You can take that money. You can invest in apartments. But this is risky. People don't realize how risky this is, because when you put money into apartments in the way that they're doing, you're actually getting leverage behind the scenes from Wall Street in the form of loans that are packaged into CRE CLOs, or collateralized loan obligations. For a long time, for years actually, this worked really well. Retail investors were making a lot of money, but that was because mainly apartment values were consistently climbing and interest rates were going down. This is very good for commercial real estate. Then when the Fed started raising interest rates, it started to go badly. All the leverage meant that the retail investors were exposed to really big losses. So we talked to a retail investor who lives in Yakima, Washington. She invested $200,000, and most of that is now gone.
So what is the problem? I mean, is it specifically rent-controlled apartments? Is this luxury apartments? Is this mid apartments? Where is the issue in that?
This is, we're talking here about multifamily apartments. So it's not, maybe some of it could be rent controlled. Mostly it's just plain old apartment complexes full of renters, and largely in the Sun Belt as well. The issue is that the valuations of these properties are very sensitive to interest rates. And when interest rates started going up, the property values started going down. And a lot of the companies that had bought these things, and into which the retail investors had contributed money, suddenly they couldn't afford their interest payments. And in some cases, they had to sell the properties. And when they sold them at a really big loss. I mean, we know that apartment values have gone down about 30% since their peak. And so when they had to sell, they were selling at these huge losses and passing those losses on to the retail investors. Now, a lot of what made these investments possible in many cases is because they were borrowing money, taking out large loans from mainly non-bank specialists on Wall Street. And that provided the leverage, and that is what exposed them to these big losses.
What are the apartment owners, what do they do, when they have some, when their inability to pay interest or pay principal, do they just sell these apartments to try to kind of raise cash?
Sometimes they get in a cash crunch, yeah. They have to pay interest, but they don't have the cash. So what can you do? You can go to your lender, you can try to get an extension, perhaps, or you can sell to somebody that is willing to buy it, even if it's at a big discount. In a couple of the cases where we talked to the retail investor, the property, and these are properties in Texas and Arizona, had to be sold at a very big discount. It gave the owner cash, but it was not enough cash to repay the money that the retail investors put in. It was enough cash to repay the debt from Wall Street. And that's the thing, the debt has to get repaid first. So when you sell at a discount in this way, it's enough money to repay the debt, it's not enough money to repay the retail investors.
So how many retail investors are getting affected by this, and what are some of the total losses that we're looking at, and is there any recourse for them?
It's really hard to know exactly how many people are exposed to this, but we do know that the altogether CRE CLOs is about an $80 billion universe. So I think it's fair to say that there's dozens of billions of dollars of, I'm speculating a little bit there. We don't have great data on exactly how many retail investors are in this thing, but it's a lot.
Yeah.
And is there recourse? Well, a lot of retail investors are waiting right now. So in this case, the retail investor we talked to, she was exposed to losses because the owner sold. But there's a lot of other retail investors out there right now who are just waiting. They're not getting cash distributions from the investments they've made. They know that they could face losses down the road when the owner has to sell. That moment has not arrived yet. It could arrive later. Also, owners could perhaps somehow recover. Apartment values could go back up again. Interest rates could go back down. It could give them an off-ramp down the road. But there's a lot of retail investors out there right now who are just waiting.
Yep.
And they don't know what's going to happen to their money.
You know, the apartment REITs that I know are very savvy investors. They know how to value things. They know how to put a proper capital structure on things so they don't get in those cash crunches. But that's not what's necessarily happening here. I noted from your reporting here. Firms known as real estate syndicators. That sounds a little dicey to me. What's a real estate syndicator?
Isn't syndicator bad? Not a bad word in finance
Yeah,
now.
syndicator. And when we say syndicator in the way that we use it in the story, we're talking about typically mid-sized firms that are relatively young. They weren't around before the great financial crisis. They rely heavily on social media. They have their own podcast shows to get the word out about their investments. They talk about how good, generally, multifamily investing is. They play up the stories of investors who've made a lot of money doing this. That's how they get the word out, and they're on YouTube. They're out there, and they're saying invest with us. And part of what makes it possible for them to do this is there was a change in the Jobs Act during the Obama administration that made it more possible to market these investments in a more public way.
All right, so that seems like a good way. We're going to have to stop it there due to time, but that people read the story, the big take story, because you learn a lot about kind of some of the pitfalls out there in real estate. And believe it or not, just reading this story, I was like, boy, we've seen this time and time again in different asset classes.
Just not with social media.
Exactly. Scott Carpenter, thanks for joining us. Scott Carpenter is a bond market reporter for Bloomberg News. Check out the Big Take story, Bloomberg.com/Big Take, or you can go on the terminal, NI space Big Take, to get those stories.
Now on Bloomberg Intelligence, Munis in Focus with Joe Mysak.
All right, folks, today's Munis in Focus in Munis is brought to you by Build America Mutual. Build America Mutual insures U.S. municipal bonds that finance essential American infrastructure and provides guaranteed income to improve any portfolio. Be part of Building America. Invest in BAM! Insured bonds.
I was late on that. I'm sorry.
A little late on that.
Yeah.
All right, it's all right. We'll get more time. I mean, I thought this guy was retiring, but we can't get rid of him. Joe Mysak is still here. He's still here. He's still doing all this municipal bond stuff. I think he did the first municipal bond way back in the Revolutionary War. He was back there covering that. Joe, you're almost done with this whole municipal bond thing, but thank you for not leaving before we had this whole mess with the congestion pricing. I mean, I'm sending you down to City Hall, and you can just fix it. I mean, so
this is madness.
So talk to us about how the pause of congestion pricing implementation, how that's impacting the municipal bond market.
Oh, what a disaster. This is just ridiculous. You know, this was supposed to begin in a couple of weeks, and, you would have been able to bond off of this and help the MTA out. But Governor Hochul all of a sudden just plays politics, and what a disaster. And the legislature now is scrambling to come up with some sort of revenue, extra revenue for the MTA, $1 billion, which is not easy to find in your budget. So crazy. This is nuts.
So let me ask the question. So how would you have sort of packaged the bonds from the congestion pricing? Can you just connect those dots for me?
Oh, sure. Well, you get the money comes in, $15 a car, and you see how that's operating, and you see the revenue stream come in. And the old axiom is, you show me a revenue stream, and I'll show you a bond issue.
Okay, and then the bonds will be backed on the revenue stream?
And the bonds are backed by the revenue stream, and you could, get a multiple of that out.
See.
So that would have been very helpful to the MTA. And, this is really, most people think, a short-term thing, more of like a temporary embarrassment, if you will. And in November, after the elections, we might see it return. Liam Denning had a nice, interesting column today. NYC balked, but it can still lead on congestion fee. And he said there was a decent chance the suspension gets lifted once the elections are out of the way. And Governor Hochul herself doesn't face voters until 2026.
So here's how the math works, as Alix was mentioning. The MTA was planning to borrow against the $1 billion in yearly congestion pricing revenue to help raise $15 billion to upgrade subway signals and tracks and all that kind of stuff. So that's kind of the leverage there in terms of, what you can put on there.
It's over time. You're not going to sell over 15 billion in 1 year, obviously. But speaking of billion-dollar issues, thank you for bringing that up. We have so far this year, in the muni market, billion-dollar issues are very unusual. Okay, they're rare, and so far this year, we've had 25 mega deals of $1 billion or more, and the record set in 2020 is 26 for the year. So we're going to far surpass that.
So what do you make of that? Like, what's your read on it?
Well, the analysts have been saying, inflation has driven up costs of projects. So places have to borrow more. And in 2 weeks, JFK for the Terminal 1 has a $1.5 billion issue planned. So we might be able to mention that. We might be able to say that the record is by the time I retire.
Okay, very good. I love the minor league stadium business out there because municipal bond market plays a role there, right?
Oh, man. We saw 2 minor league stadium deals in 1 week. I think, we probably saw 2 minor league stadium deals in the last year. But we had, both in 1 week. And the most recent one was for the Spartan Burgers.
Spartan Burgers.
And kind of an interesting little deal, and it was just federally taxable, so you had over 6% coupons on that one, or 6% coupon.
Well, actually, just let me circle back for a second to the $1 billion bonds that we've seen. You said 25. You're looking at JFK 1.5. Like, what's the takedown for that?
Pardon?
What's the takedown for that? Is there strong demand for that stuff? Huge.
Oh, we have seen blowout demand on deals this year.
Is it all Paul?
Demand for tax exemption. So far, we have, let's see, I think it's about $205 billion has been sold so far this year. And not even, we're not even done with the first half. So we could very well see in the muni market, and again, $400 billion deals are unusual. So we're certainly going to see an excess of that. I wouldn't be surprised if we saw $450 billion. But of course, I won't be able to defend that. I won't be able to be blamed for that prediction.
Alix, in Lower Manhattan, right by the offices that used to be for Kidder Peabody on Hanover Square, power part of Lower Manhattan back in the day, there is a classic bar, Wall Street trader banker bar, Harry's on Hanover Square.
Oh, I know Harry's.
Yeah.
Yeah, I used to work down on Wall Street.
Big time. Joe, what's Harry's at Hanover Square mean to you?
Oh, man. So, I remember getting a lot of stories in Harry's, believe it or not, because it was primarily a muni bond hangout, which seemed to me.
I didn't know that.
Does that mean that all the muni people who like it and talk about it go and chill there?
Yeah, they would go there, and of course now it's sort of reconfigured, but there was this big rectangular bar in the middle of the room, and be surrounded like 4 and 5 deep, smoking because smoking was allowed then. You just be listening to people bark about trades they made that day. I remember I went to an especially long lunch. And I needed to get a preliminary official statement for as a matter of fact, it was $1 billion deal for a very small Texas community, and of course the bonds were going to be locked away in some investment vehicle, and never really used. And the IRS did not like that idea. But I did get that document out of such a lunch at Harry's at Hanover Square.
Sourcing, it's important. You need that stuff. But it has a place in the muni bond market too, right? Like not just hanging out and chatting. Like, is there a bigger muni?
Well, we had we used to have two Munifax screens there, as a matter of fact. And it's one of those places where everyone used to go and just chat about how, what's going on.
I love that. When's the last day?
June 28th.
June
28th. We're getting there.
So how many years, Joe's retiring, so how many years total in covering this municipal bond space?
43.
43 years covering the municipal bond industry.
I'm not sure who's going to challenge that.
I don't know who's going to challenge that. And how many years doing that at Bloomberg?
25.
Wow. Okay. So what's the
amazing.
biggest change in the muni bond market from when you started?
Well,
I mean, it's never going anywhere. They're always going to need money.
No, when I started, a $50 billion year was kind of the average, and now it's nearing 400 billion a year, and that took quite a while to get there. It's always been a retail-oriented market, but now you have growth of the separately managed accounts, which is individuals, but
the ETFs.
it's very professionals. So, a lot of professional involvement. And gosh, the earliest things we were covering were pay to play in the municipal bond market, and the MSRB prohibited pay to play. So underwriters can no longer give money to issuers from whom they're soliciting business. And the treasurers were very angry about that.
Yep, I'm sure they were. All right, Joe, guess what?
That's it?
That's it.
That's
for
it.
This week. It's not it, because we got till June 28th with you, so we will get you on. Again, no doubt about that. Mark, make a note of that. Joe Mysak, he is the editor of Bloomberg Brief, covering all the municipal bonds markets, as he's been doing it for 43 years?
Yes, indeed.
43 years. Holy cow.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
It's Bloomberg Intelligence Radio. We bring you all the top news in finance and economics and business through our lens of Bloomberg Intelligence analysts. They cover 2,000 companies in 130 industries worldwide. And for the month of June, Bloomberg Radio is committed to bringing you segments and guests that are focused on the topic of equality. And today, we're speaking with Laura Mowdy. She's CEO and co-founder of Bobbie. Laura, thank you so much for joining us. We appreciate you being on this first segment for us this month. What is Bobbie?
Bobbie is an organic, pasture-raised infant formula company, and we are raising the bar and quality of infant formula here in the country.
So we talked to you during what we had a shortage of infant baby formula. Can you remind us how that all developed and how that came about, and maybe how that impacted your business?
I think we can all remember it happened overnight. No one saw it coming. As a country, we weren't prepared. Bobbie itself, being a small company at the time, also wasn't prepared. One company that was feeding over 50% of babies born in the country had a contamination, and they had to close their doors. And when they did, they weren't able to meet the supply needs of feeding American babies. And overnight, we saw out-of-stock rates climb to around 70%, which essentially meant that American families were driving town to town, and in some situations, state to state, where there was only a 30% chance of being able to find food to feed their baby.
So what is the problem with infant formula that you're trying to fix?
It's pretty simple. We need to be more resilient. Let me give you a little bit of a mother's opinion on this as well. I think the infant formula shortage, a moment where we were not resilient enough to be able to feed our next generation, was actually a bit more symbolic in many ways of what's really broken in the country. One might argue that our entire democracy is only as strong as our ability to be able to feed our babies. And we were not resilient in any way. One facility went down and the entire industry fell to its knees. What we need to see is more manufacturers. More manufacturers in the heartland of America where we can ensure that there's always enough supply to be able to feed babies.
Yeah.
And I think the way we do that is incentivize more domestic manufacturing.
But aside from that, Laura, like with Bobbie, what is the problem that you're trying to fix with the infant formula that's so entrenched in our society today?
We need to be able to look at this essential good as not just a necessary, but a necessary that's extremely important in the development of our next generation. The quality of what goes into that baby bottle, the nutrition that we're giving, again, our babies and the next generation is fundamental for their growth and development. And I think we've ignored it for far too long. For the last few decades, the same infant formula that you yourself was drinking as a child is probably the same infant formula that you're now buying for your own baby.
Wow.
Science has evolved a very long time ago. And in every other industry, we've seen an evolution. And I think this might be the last remaining industry we've seen this.
So you talked about, Laurie, we need more manufacturing and more diversified manufacturing sourcing here in the U.S. What are you guys doing on that front?
Well, not only did we go out and we made a commitment that we were going to invest $100 million into domestic manufacturing, we bought and we have reinvested in a facility in the Heartland in Ohio. And that facility now has the ability to be able to feed up to 15% of babies born in the country. But on top of that, we also worked very closely with legislators to introduce the Infant Formula Made in America Act. We did this last month with Congress. And what it essentially allows is incentivizing more players like Bobbie to be able to break into the industry. It takes a lot of capital and a lot of time, and we need a lot of support from government officials to make this happen. So hopefully, if this bill gets passed, which is what I believe is a very bipartisan solution to being able to not be in another shortage again.
And how did you come up with this idea? Yeah. Did you come from Wall Street? Have you always been an advocate of this? Like, where did this all come from?
Great question. Do not come from Wall Street. I actually don't even come from CPG infant formula at all. My background is in tech. Before this at Google and at Airbnb. I had my first daughter while I was an executive at Airbnb, and I experienced all the ups and downs of parenthood, and one of many being the disappointment that I wasn't able to exclusively breastfeed her. And when I turned to infant formula, I felt a feeling I had never experienced before, that shame and guilt that I wasn't able to give her what I thought was so natural. And then as, you know, a business woman, I was staring at the back of the can going, we can do better. And that set me on a crazy research journey to study what was best for my baby. And I'm here now 8 years later, and many more children, by the way. I just had my fourth kid, who is happily guzzling some Bobbie.
Congratulations. Laura, what's the risk that we have another type of, supply shock here, to supply disruption? Are we any better off today than we were before?
Oh, I get sad even trying to answer that, because I don't believe so. It's very easy to get complacent in these moments when shelves are stocked. But when you look at the reason that we got here, have we introduced many more manufacturers? No. Have we been incentivizing new players to break in and break up the concentration? No. So I believe we're still one bacteria away from this potentially happening again. And my big call to action is that we just don't allow complacency, seeing shelves get stocked, as a way to ignore the real solution, which is let's get this bill passed and more manufacturers up and running.
What is this, aside from like money and funding, what is the next step after we try and get this bill passed that you're sort of looking at right now?
You know what? I think it's culture change. So taking a hard pivot from domestic manufacturing, we need to have the level of respect that infant formula deserves. And not just infant formula. I mentioned it was symbolic to so many different things. What's broken in our society is that the same government who says that you should be exclusively breastfeeding is also telling mothers that they need to get back to work immediately. We need to pass paid leave. We need to fix childcare. We need to be able to support parents being parents in America. And if Bobbie can have any role in changing the culture, by which it means to have a baby in this country, then we're doing our job.
How are you doing that? Just these kind of conversations? Is it advertising? Like, how do you do that?
Yeah, I mean, it's a lot of activism. And I think it's a word that sometimes gets overly used, but it's activism, and the underlying meaning of that is action. And we're taking a lot of action by reaching out to our customers and the public and saying, sign this petition to be able to get this bill passed, raise awareness on the Black maternal mortality crisis by putting our own brand dollars behind raising awareness on this. We've recently won a few awards for, again, not just marketing infant formula, but marketing the issues around it. And I think if more companies, again, can lean into fixing the systemic issues for why they fundamentally exist, then you get to change culture.
Hey, Laura, we got to leave it there. Really enjoyed talking to you. I wish Bobbie was around when I had my daughter almost 10 years ago. Laura Modi, CEO and co-founder of Bobbie. We're going to bring you some of these great stories over the month of June. That was just an fascinating conversation.
Yeah, at least I was introduced to her during the shortage. Very interesting.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.